to see where rates are right now. I mean, I think we had a uptick quite a bit again yesterday, almost up to 4%, I believe. It was 390 something on the 10-year. We did see those pull back again, thankfully, to I think we're somewhere around a 3.74 10-year rate. You definitely have a little bit of an invert in the yield curve with the shorter term rates still being a little bit higher than your longer term. We are seeing that, this increase, we're hearing different things from the people we work with as far as, capital sources we connect with constantly, as well as real estate owners that we're also working with. There's mixed opinions. We have a capital market call that we do internally here at Plum, which, has senior individuals who are executives at large name, real estate groups. Some of them were BlackRock, some of them were other, tech, type companies as well, and to get their perspectives. And through those, we, as mentioned, see the differences. I mean, there's some groups that we interact with, some life companies, they're showing that on the equity, their equity desk is telling them that, be thinking maybe 3% 10-year, which is quite a bit different than where we have seen rates go. Their view is, I guess, the Fed's kind of, moving a little fast, and that the items out there will catch up. And maybe by the end of the year, we do see a continued decline in 10 years. I'm not saying that's our perspective or my perspective. I mean, personally, I see rates kind of, increasing a little bit more. I think there could be a chance it could pull back, towards the end of the year. But when you look at where the historical average of the 10-year, I think it's, on a historical basis, I think it's around 426. You look at where I believe the 10-year was back in the early 2000s prior to the Great Recession. You're talking, I believe, 10-year, if I'm not mistaken, was in the 4.5, 480 range. So it's not like we haven't been here before. Fortunately, where rates are, in the 10-year coming up after the Great Recession, you did see a number of different lenders try to find ways to prevent what happened in the early 2000s from occurring again. We saw, LTVs pull back. When you look at a lot of the issuance in the Freddie series on the multifamily side, you look at where life companies kind of set their thresholds for their better rated deals and what they call CM1 deals. They set them at a 1.5 debt cover. So, that was really not pushing the debt coverages we were back in the early 2000s. When you look at the LTVs, the life company, GSEs and others had at 65, 70%. You still had, based on the math, you probably were still looking at 1.35, 1.4 debt coverages. We're back in the early 2000s. I remember constantly underwriting deals to 1.20. If we were pushing it, we may have been pushing to 1.15. So, it's different. There's an adjustment period that needs to be made. But the owners that we work with, we find are, they understand the markets. In some situations, we typically work a lot on the refinance side as well. And, fortunately for them, they've paid down their deals, and there's not a whole lot of concerns with the refinance, maybe a little bit less of ability to pull equity out. Their debt service may go up, but there's not deals that are, not being able to get done in this market.
Are you seeing capital stacks look different than they did like 3 months ago in terms of leverage ratios, et cetera?
LTVs, as far as the leverage ratios themselves, we are seeing, as rates have gone up, some lenders have been willing to take a little bit higher leverage point based on recognizing that's going to correct itself over time. But at the same point, reality is most of the deals that we have seen have had amortization built into them. So, we're working on, a couple deals right now that were 2012, 2013 issuance in CMBS. We're looking at deals in this case. They have a, 16, 17 debt yield, a 45% loan to value because they've been amortized down over the last 10 years. And the rates, back then, now they were lower than where we are today, but they weren't substantially lower back in, 2012, 13, which is where you're seeing a lot of the roll off on 10-year deals.